In this video we are going to talk about why you should invest in dividend stocks. So before starting this video, please like this video and subscribe to this channel for our future updates. Many first-time investors are unfamiliar with the concept of a dividend and how it relates to an investment, particularly when it comes to individual stocks or mutual funds. It is customary for publicly traded companies to pay out dividends to their stockholders, who are eligible to receive a portion of the profits made by the company. However, not all corporations distribute dividends. Typically, the board of directors determines whether or not a dividend is desirable for their particular company based on a variety of financial and economic considerations. In most cases, dividends are paid to shareholders in the form of cash distributions, which are made on a monthly, quarterly, or yearly basis. Before receiving a dividend payout, or distribution, on their stock, shareholders of a given company must first meet a number of requirements. It is necessary to be a shareholder of record on or after a specific date designated by the company's board of directors in order to be eligible for the dividend payout to be eligible. Occasionally, stocks are referred to as trading ex-dividend, which simply means that they are trading on that particular day without being eligible for a dividend distribution. Purchase and sale of stock on the ex-dividend date will result in the stock not receiving the most recent dividend payout. Now that you have a basic understanding of what a dividend is and how it is distributed, let's go into greater detail about what else you should know before making an investment decision in the stock market. What is the dividend yield in this case? It may seem counterintuitive, but as the price of a company rises, the dividend yield of that stock lowers. Dividend yield is a measure of how much cash flow you are receiving for every dollar you invest in a stock or other investment. Many new investors may make the mistake of assuming that a greater stock price equates to a larger dividend yield, which is simply not true. Let's take a look at how dividend yield is calculated to get a better understanding of this inverse relationship. Dividends are typically paid out on a per-share basis in most cases. If you possess 100 shares of the ABC Corporation, the 100 shares serve as the basis for the distribution of dividends to you. Take, for example, the assumption that ABC Corporation was purchased at a price of $100 per share, resulting in a $10,000 total investment. Profits at the ABC Corporation were extraordinarily high, and as a result, the company's board of directors has agreed to give its stockholders $10 per share in cash on an annual basis. In other words, if you are an owner of ABC Corporation for a year, your ongoing investment in ABC Corporation results in dividends of $1,000. The annual yield is calculated by dividing the total dividend amount, $1,000, by the cost of the stock, $10,000, which results in a yield of 10%. In contrast, if ABC Corporation shares were purchased for $200 per share instead, the yield would be reduced to 5%, because 100 shares would cost $20,000 instead of $10,000, or your original $10,000 would only buy 50 instead of 100 shares. As previously showed, if the price of a stock rises, the dividend yield falls, and vice versa if the stock price falls. The essential issue to ask is whether dividend-paying equities are a good overall investment in terms of overall return. Dividends are earned from a company's profits, thus it is reasonable to infer that dividends are generally regarded as a positive indicator of the company's financial health. From the perspective of investment strategy, purchasing established companies with a track record of paying out high dividends gives stability to a portfolio. If you keep your $10,000 investment in ABC Corporation for 1 year, it will be worth $11,000, assuming the stock price remains same after 1 year. More to the point, even if ABC Corporation stock is trading at $90 per share a year after you purchased it for $100 a share, your entire investment, including dividends, is still break-even, $9,000 in stock value plus $1,000 in dividends. Buying stocks with dividends has the advantage of not only helping to cushion drops in the real stock price, but also providing the chance for stock price rise while also providing a continuous stream of income through dividends, which is appealing. For this reason, many investing legends, such as Warren Buffett and Benjamin Graham, advocate for the purchase of dividend-paying stocks, believing that dividends are a crucial component of the total investment return of an asset. Investment in dividend-paying corporations, on the other hand, may be an appealing option if it is suitable to your level of financial expertise. Now, let's take a look at what dividends are and what benefits they could potentially provide for shareholders. A share of company profits. A dividend is a percentage of a company's profits that is distributed to the company's shareholders, either in cash or in the form of stock. In contrast to fast-growing companies, which may choose to reinvest their profits in order to achieve even greater growth, more established and mature businesses may be more inclined to distribute a portion of their profits to shareholders in the form of regular dividend payments. Dividend stocks as a long-term return driver. Dividend payments may appear minor in the short term from the perspective of an investor's portfolio. While over the long term, dividends have been proved to constitute a significant share of total investment returns from the stock market, this has not always been the case. When dividends are excluded from the computation, the FTSE 100 index, according to Bloomberg, returned slightly less than 15% over a 10-year period ending at the close of 2016. In contrast, when dividends were reinvested and included in the index's performance throughout that period, the total return was 67%. A big difference exists between the two options. Past performance does not serve as a predictor of future performance. Generate passive income. Another significant advantage of dividends is that they can be used to generate a source of passive income. An investor who seeks to produce a significant income stream can do so by constructing a portfolio of stocks in the FTSE 100 index that yield more than 4%. Regular cash. Dividend payments, on the other hand, can give the investor with an opportunity to put the power of compounding to work for him or her as well. When earnings from prior investments are reinvested, the process is known as compounding, and it can result in the growth of an investor's total portfolio value over time. Reinvesting dividends increases the likelihood of generating additional dividends in the future, if the dividends are properly managed. In addition to increasing in value, assets, and the income received from them have the potential to decrease in value as well as increase in value. Increased protection during periods of market instability. Finally, during moments of market volatility, dividend stocks frequently tend to decline less than growth stocks in the long run. Companies that pay dividends are often well-established businesses with a proven track record of profitability. As a result, during moments of high volatility, investors frequently gravitate towards these companies. Have you given any thought to including dividend stocks in your investment portfolio? Get in touch with us today to speak with an independent financial advisor, who will be able to provide you with the guidance you require to make the best financial decision for you and your family. They offer dual benefits to investors. Despite the fact that dividend stocks may not have a better growth potential than growth stocks, they do have the ability to appreciate in value. Investing in dividend stocks allows investors to take advantage of all of the dual benefits that come with them, including as capital appreciation and constant, regular income. For example, an investor can make an investment in a stock with a high dividend yield and reap the rewards for a number of years. Later on, he will be able to sell your investment and make a substantial profit on his investment once more. They help you fight inflation. While the inflation rate continues to rise on a daily basis and is on an upward trend, it is critical to make investments that are both effective and inflation-proof. An investor can do this by investing in dividend equities, particularly dividend growth stocks. With a high dividend yield, dividend yields that are increasing will assist you in combating growing inflation rates and voiding them. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.